Hi, and welcome to the 2012-13 National Budget Update. I'm Matthew Lester. Well, what's this budget all about? Worldwide, there is an economic storm. The big problem is, can South Africa survive? Answer, yes, we can. But the big question is, how are we going to pay for it? It's all about growth rates at the moment. Notice that growth rates dipped towards the end of the Mbeki administration. Then Zuma came in and things got a lot better. He appointed Minister of Finance, Pravin. He took over from Trevor Manuel in May 2009, and immediately growth rates did quite well. When we got to budget 2010-11, things were looking a hell of a lot better than they were a year later. And that went on right through 2011. The problem has been that in the last year, things have started to dip off. And that is a major threat to the security of South Africa's financial situation. When we looked at budget 2011-12, a year ago from now, Gordhans said we'd recovered from the area in red, that was the global credit crunch, and we'd had a relatively stable year with an average growth rate of over 3%. So Gordhans set a target for 2011-12 at 3.2%. Subsequently, in the medium-term budget framework speech, he had to revise that down because the initial growth rates were at 4%, but then slowed to well below 2%. So in October, the forecast was dropped to 3%. Growth rates have a huge effect on where we are going. And one has to say, what's the future going to be? Well, Jill Marcus 3 weeks ago predicted growth rates would continue at 2.8%. The head of the IMF said South Africa's growth rates would slow to 2.5%. Pravin in the budget has made the call, let's split the difference, 2.7% growth rate, but increasing to 4.2% by 2014. So if one takes the figures as they were last year with the budgeted deficits, we find that at the medium-term budget framework speech in October 2011, only small adjustments were made to the forecasts, and that was simply to take account of slowing VAT collections. It's important to see whether that has changed, and basically it hasn't. The changes that have been made to the expected deficits are relatively small. They've cleaned up the deficits of the last couple of years. And then the revised forecasts show that deficits will change marginally, but remain at above 4% for the next 2 years. And then only start slowing down to the 3% that they started forecasting for 2013-14. That's now going to happen in 2014-2015. So hopefully by the end of 2015, we'll be at a 3.1% growth rate. Why are growth rates so important? What's all the fuss about? Because if the growth rate goes down, tax receipts drop, especially VAT. That leads to an increase in a national deficit, which leads to a downgrade by the ratings agencies. And that we simply cannot afford because that results in an interest rate increase and economic chaos. The big game must be to maintain our credit rating and to maintain interest rates at their low levels. The consumer cannot take an increase in interest rates coupled with an increase in fuel prices, electricity prices, and all the costs of daily living. That's the big thing that they've got to check out. Compared to the rest of the world, we're looking pretty perky. There are your disasters overseas, and we see that South Africa's debt to GDP ratio is still below 40%, and although it's climbing a little bit, we are a model example for the rest of the world. Back in October, they identified that VAT collections for this year would be about 13 billion rand short. Let's see how they come out in the final analysis. Well, at the end of the day, the prediction on VAT came right, 10 billion short. The good news was that although personal tax came up a little bit short and the inevitable drop in transfer duties resulted, corporate tax came to the fore and came in 8 billion rand over budget, and 1.5 billion on STC. Then we smoked too much and drank too much as usual, and so that put a little bit extra in the kitty, and overall we made it, even with a little bit of carbon tax. So where we are in the actual collections for 2012 is that we can say corporate saved the day. Personal taxes almost got there, 3 billion or so in 253, who really cares, and VAT was a little bit down. But the big question is, or the big issue is, that we were only 4 billion off the mark in the context of 742 billion rands in tax collections. If one looks at it, though, we say, well, where is the emphasis of tax in South Africa? And we see that the individual taxpayer is carrying a very heavy load at 34% of the total pie, and then one has to add VAT to that. Corporates are now going to be attacked this year. Their level has dropped to 21%. It can't drop any further, so they're going to have a hard time of it going forward, and then value-added tax will stay more or less the same as it was, allowing for a little bit of inflation. You can see that the rest of them are not exactly going to solve South Africa's problems individually. So here's the game plan for 2012-13 moving forward. They've got to get more from companies, 16 billion, and that's going to come by way of increased CGT and increased dividend tax. We will not have a decline as a result of the conversion from STC to dividend tax because of increasing the dividend tax rate from 10% forecast to 15%. Then they'll hammer in on fuel and sin tax, etc., as they do every year. VAT, they hope, will do it just with inflation. They're not expecting a huge increase in consumer sentiment. And then, unfortunately, they have to revisit the individual again, adding in extra taxable income in the form of the medical credit relief, which has changed, the inclusion of your group life cover in your taxable income, those are changes from last year, and then an increase in the inclusion rate on your CGT from 25 to 33%, all to be discussed later. At the end of the day, here's how we look. We have three big taxes, the biggest being individuals tax, followed by VAT, followed by companies. They have to get companies contributing again and reverse that trend because the remainder are pretty insignificant. Even fuel and customs and excise duties are less than 2% of GDP. Not major numbers there. When one looks at individuals tax, there's the picture of South Africa. We have a position where, in the middle order, salary 10,000 rands per month or 120,000 per year, up to 500,000. Those are the majority of the taxpayers, and they are taking a huge amount of the load. They're the middle class, and they have to do a lot of work and still get taxed. Up the top, we see that there are taxpayers who are making a contribution, but we see that they are very small in number. And that's an important issue. Increasing the super tax rate is not going to help them. There simply aren't enough taxpayers. So looking at who pays the tax, well, you can start off with 19% is paid 1 to 60,000, very little. Okay, then it starts increasing above 5,000 rand per month, but the major taxes are being paid 120,000 and above through to 400,000, and then super tax and upwards, they take 54% of the total load. Provisional tax, we see that there has been a remarkable change as a result of the change in the second provisional tax payment. We see now that SARS is collecting more and more from the second payment, 53% of the total from the second provisional tax payment alone. Further, we see that if one looks at all the sources of income, they are now all subject to employees' tax with the exception of local interest. And this again is a position why it is so difficult to tax plan, because it leaves the employer at risk if there's a problem. But overall, we see a trend that has emerged over the last couple of years. As individuals' tax has forged ahead, company taxes in blue have lagged behind. And this is the budget where they are trying to correct that. They're trying to say the individual is taking too much of the tax load. The shortfall that's got to be made up this year is going to be made up by the companies. But sticking with the individual again, we say, right, take the 2012 tax tables and play the game that every Minister of Finance does. They say they're putting money back. So there are the numbers. Manuel said 13 billion in 2009, and that gradually increases to Pravin Gordhans' announcement this year of 9.5 billion rands of tax going back to the taxpayer. Unfortunately, it doesn't really work that way, and we have to understand it a little bit better. When we take the 2013 tax tables, what they've done is that they've increased the bottom bracket, then adjusted the middle, and increase the top bracket. Add on to all three primary rebates a little bit, and take up the tax threshold to very lowest level 63,556, and then you add the rebates in and you get 99,058 for all over 65s, and a staggering 110,889 for over 75s. And that gives you your new tax table. But tax tables are one thing. You have to look and see what's the overall effect in the computation of taxable income. And this is where there are some major changes, because we've got the medical credit. We dropped the old system of having a tax-free medical aid subsidy. That turns into the Section 6A rebate. It was proposed at 216 rands for the first two members of the medical aid last year. That's been pushed up to 230, and for subsequent members, the 144 proposed last year has been pushed up to 154. Additional expenditure will qualify for the rebate if it exceeds 7.5% of taxable income, but the rebate will be limited to 25% of the additional expenditure. And then over 65s will join in this system with effect from 1 March 2014. If one does some computations, it's quite terrifying. Take a person who earns 750,000 rands today. If one took that back using an 8% inflation factor, which is the average increase in remuneration over the last few years, one finds that in 2010, that person was receiving 595,000. But in 2010, he had a travel allowance deduction. That's now gone. In 2011 and 12, they still had the medical aid tax-free subsidy, indicated there in red at 27,840. They also received tax-free fringe benefits. But what happens now is that the medical aid tax-free subsidy now becomes a rebate. And on top of that, the group life premium becomes taxable on a monthly basis, and the permanent health insurance premium also becomes taxable on a monthly basis. The net result of all of this put together and applying the new tax rates is that the effective rate of tax on this chap in 2010 was 24.27%, and it has increased to 29.43% by 2013. It's not only a question of tax tables, it's also a question of how much you are being taxed on. The interest exemption that we had to use learn for the board exam has been repealed. Thank God for that one. And now we get a 30,000 general exemption per annum. It covers all investment income, dividends, capital, etc., with a 500,000 rand maximum in a lifetime ceiling. They're also going to bring in a preferred savings scheme with effect from April 2014. We are going to continue in the next video by having a look at the horrors of dividend tax and increased capital gains tax rates.